Okay. Okay, so good morning. There are very few people attended the bridge day, so I was expecting very few. You already very few, but best. So quality matters more than quantity. So any questions from the lecture is now 2 weeks ago, which I think it was on regulation of digital currencies. I mean, a topic on which you also come back. Hi. Or anything else that you want to ask? I mean, did you receive the date of the exam? You know when the exam is? Yeah? When is it? You remember?
I think the 20th of July.
20th of July, okay. Okay, very good. Yeah. Okay, it's pretty early then. 20th of July, you sure? Okay, this means that we had to finish at least 1 week earlier, if not even earlier. Okay. So I need to plan a bit about that, because normally it's end of July, even beginning of August. I mean, in other years where I've been teaching, but okay. So I'll make sure that we finish well in time, that you have a bit of time to review material and so forth. So this probably means that probably the last lecture will be around the 10th of July, I guess. Okay. Good. Okay. So today then we can discuss about central bank digital currencies. So let's get started. So central bank digital currencies, the acronym is used by everybody, is CBDC. So what is a CBDC? So it's a digital asset. Okay, so it's immaterial, it's digital. Where the issuer, so the issuer is the central bank. This means that it's a liability of the central bank. I mean, this we have already seen when we had this taxonomy of digital currencies. So the CBDC will be on the liability side of the central bank balance sheet. And I mean, of course, there is already an asset that is digital and it's in the liability side of the central bank, which is what? So what is another asset that is already digital, that is already a liability of the central bank? Very easy. What do banks do with the so what is the relation between banks and the central bank? What do banks hold with the central bank? Yeah? Reserves, exactly. So the banks hold reserves at the central bank. Okay? They actually borrow from the central bank to hold reserves at the central bank. So basically they borrow from the central bank, but then they deposit their borrowing of central bank money at the central bank. So the central bank has a liability vis-a-vis banks, vis-a-vis commercial banks, which is usually called reserves. So bank reserves. Bank reserves are already digital. Okay, banks also have some cash, which is also a kind of reserves, which is called vault cash, which is basically the cash in the vaults. Okay, and this cash is used for cash dispensers. When you go to the cash dispenser, you get cash from the cash machine. That comes from the vault cash of the banks. But most of the reserves, I don't know how much, but probably 90-95% is held in a digital way at the central bank. Okay, so there is a digital. So the central banks already have a digital liability vis-a-vis commercial banks, but they don't have digital liability vis-a-vis us, so vis-a-vis citizens. Okay, so the CBDC is essentially the same thing, but rather being towards banks is towards everybody, towards citizens, towards private citizens. So this is why people sometimes call a CBDC a reserves for all. Okay, so at the moment, not everybody can deposit a reserve in the central bank. In the future, with the CBDC, everybody will be able to deposit something at the central bank. Okay. The other liability of a central bank is a form of physical banknotes. So is the euro, the dollar banknotes that you have in your wallet. Okay. So that's, a CBDC is also a digital equivalent of banknotes. So the banknotes, again, are in the liability side of the central bank, and they are in physical form. A CBDC will be the same thing, just not physical, but digital. What is a key difference between physical banknotes and digital, if you want digital banknotes, is that digital is, as we discussed already, is easier to store and also to distribute. Okay, so one key problem of physical banknotes is that it's not easy to store them. Okay, you can put the cash in your mattress, or you can put the cash, you can bury the cash underground and so on, but normally it's hard to store very big quantities of cash. Okay, so if you have if you have €1,000,000 in cash, that's really takes a lot of space, and this is a risk of being stolen or maybe destroyed and so forth. So you've seen the movies where people have a luggage with all banknotes in it, and so, but that's only in the movies. It's hard actually to use cash to store value. So, but in digital form, it's much easier because in digital it's just a number, like a bank deposit, and so it's much easier to move around, to store, to distribute. So the digital makes a big advantage over the physical form. But conceptually, a CBDC is not very different from a digital version of physical banknotes. Okay. So what are the characteristics of this CBDC? So first of all, it's safe. Okay, it's safe at least in terms of the legal tender currency. So if the euro is a legal tender in Europe, for example, a CBDC is completely safe in terms of the euro. Of course, if the euro depreciates against the dollar, for example, or if there is inflation, that does not make, of course, the CBDC safe. Okay, so in that sense, it's not completely safe in terms of in real terms. It's never completely safe, but in nominal terms, so vis-a-vis the currency that is legal tender in that country, a CBDC is completely safe. And this is different from bank deposits because bank deposits are, in theory, at risk if the bank issuing them goes bankrupt. Okay, so if the bank goes bankrupt, you can lose the money. Okay, there is deposit insurance, so there are safeguards. But in principle, you can lose some part of your funds in the case of bank deposits. But in case of CBDC, in nominal terms, you can never lose. A second feature is universal access. So this being issued by a public institution towards citizens, it has to ensure that all citizens have access. At least within the domestic jurisdiction, or everybody should have access to it. And I mean, a key feature also of a CBDC, is, because again it's digital, is that it can be distributed in different ways. Okay, there are different ways to distribute a CBDC. It can also be distributed on a blockchain, for example. So there is a flexibility in terms of how this is distributed. This is a key also design issue for central banks in terms of introducing a CBDC. I will come back to that later also. So there is, but keep in mind this flexibility in distributing, because there are can be distributed in many different ways. It can be on mobile phones or there are many different ways to distribute the digital euro. The CBDC in general. Any question on this definition? Okay, so let's spend a couple of minutes on physical cash. So you're the bank. I don't know if you still hold banknotes because it's becoming less and less popular. But so physical cash is one form of outside money. So remember we had this discussion inside versus outside money. Okay, outside money comes from outside the private sector. Okay, and so physical cash is one form of outside money. So what is the other form of outside money? Same as before. So it's bank reserves is the other form. So the total central bank money is the sum of physical cash. So it's basically banknotes in circulation plus bank reserves. So the two together make up the liability side of the central bank balance sheet, and the sum of the two is the total of central bank money. Okay. So these are the two forms of outside money. And so physical cash is one component of this. And I mean, I think we already discussed that physical cash is not really the main means of payment. So in a modern economy, the main means of payment is essentially bank deposits. So it's basically inside money. Okay, outside money is a small part. It's like 2%, 3%, 5% of total payments. Okay, but most of it comes from some form of bank deposit. Okay, So, but what is unique of physical cash? So, so one key feature of physical cash is you can use it without a bank account. So, I mean, we discussed already, and many people don't have a bank account. So, physical cash is used for people without a bank account. And there are people even in our countries. I mean, I was last week in Italy, and there was a cleaning lady, and this cleaning lady didn't have a bank account, so I had to pay her in cash. You know, it's I mean, for me, it looks weird to me, but there are many people, especially in the kind of maybe a little bit in less formalized occupations, say, it's you know, there are many people without a bank account. So cash can reach people who don't have a bank account. Also, you may not have internet connection. So you should not kind of take for granted that everybody has an internet connection, also knows how to use internet. So again, cash can be used without an internet connection. And maybe the most defining feature of cash is that it basically ensures full anonymity. Okay, so it's a better instrument. So if you, I mean, you remember all discussion we had on trust and so on. So you don't need to, I mean, you can be, you know, either a very bad person or doing something very illegal, but you know, cash is fungible, so is very hard to track cash. I mean, there are ways to track cash in using the banknote numbers, so the serial number of the banknote, but it's hard to do. So generally, the cash is you know, guarantees full anonymity, which has pros and cons. You know? So it can also, you know, can have advantages, also disadvantages. Third point, you know, everybody is saying that cash is declining. Is not so clear. Okay, so it's true that in many advanced economies, cash is declining rapidly. I mean, you can travel to places without using banknotes. I mean, you travel to the U.S., for example, you can easily, you know, survive without even having a single dollar banknote, or the Nordic countries, another example. But in other countries, I mean, I think in Germany it's still used, for example. So in Japan as well. So overall, the evidence that cash is declining everywhere is not there. It's not really there. It's mixed at least, and it's not even clear that cash will disappear later. So it's not even that is not even clear. So the message here: don't take for granted that cash will disappear or decline rapidly. But it's certain that in some parts of the economy or in some countries is disappearing very fast. Okay, and where it is disappearing very fast, obviously, is in digital markets. So if digital markets expand, of course, the use of cash declines, because you can't pay, and I don't know, you can order anything on Amazon and pay in cash, obviously, you know? So you need some digital form of payment. So digital markets means digital form of payments, and not physical cash. We know that physical cash is used a lot for illegal reasons. So the informal economy is, you know, thrives on cash. So this is one of the reasons why some people dislike cash, physical cash, because it's used for the legal reasons. So given all this, given that, you know, cash is, at least in some important parts of the economy, is declining or is less important, is quite natural that central banks are thinking of alternatives. Okay, it's in a world where cash disappears, again, not everywhere, but at least in some parts of the economy, basically nobody in these parts of the economy at least will want to use physical cash, which is one key form of central bank money. So if central bank money wants to continue to exist, it has to become more digital. That's what central banks are trying to do. So they are trying to move to the digital world, so to offer something that is digital. So that's the idea of the push towards the CBDC. Interrupt me if you have any questions. Huh? Do you use physical cash? Yeah? Okay. No? I mean, I think Germany is a bit of a mixed case. I mean, it's becoming more and more digital, I have to say. So in last years, I've seen more and more use of... but for example, so here there is a lot of... I see that there is a lot of attention to avoiding fraud. So when you pay with cards, you always have to put the PIN number, so some password or some number. Because, you know, in other countries, they don't care. So if you go to London and you pay with a card, they never ask you for anything. They just swipe the card and it's done in 1 second. So it's a bit of a different, also cultural difference. I mean, I think here in this country and in other countries also, the plastic money is still looked at with a bit of suspicion, I had the impression, no? But it's not, not everywhere, no? It's, and China is yet another. So China has its own payments, as we discussed, no? So in China, it's either cash or you can use your mobile phone, no? But sometimes cards are not accepted in China. So it's a bit of every country has a bit of a different take. Okay. Yeah. So there is a growing interest in CBDC around the world. So there was a boom in interest in the last few years. So there are many trackers globally of how many countries are considering a CBDC. There is this tracker that you can consult by the Atlantic Council. So you hear there's a lot of information in there. You want to click on this. But the key message here is that over 80% of countries are considering introducing CBDC. No? And 9% of countries in the world have already introduced it. 14% are in a pilot and 23% in development. So, I mean, if you sum these, I mean, over probably around 50% are developing actively some kind of CBDC. And all major central banks in the world are considering a CBDC. Some a bit less actively, so the Federal Reserve, which is the most important central bank in the world, the central bank of the United States, is still thinking about it, and there are different views. I mean, US is a bit of a specific case. I mean, we will discuss this next week, but the US is a dominant currency in the world, so has a special place. And on the other hand, is also a country where there is a deep rooted suspicion about central banks more than in other countries, and this also is an element. So, but we'll discuss next week when we discuss the international aspects. But so the US is a bit of a special case, but in general, most of the key economies are actively considering a CBDC, including the euro area. I'll discuss in a second. Yeah. So a lot of so if you are worried about CBDC, and some people are worried, that we discuss that. So be aware that this is coming. So it's something that is coming. Or if you hope in it, or you have hope, also is coming. Okay, so what are the reasons? So why do we want to introduce CBDC? So there are some, I would say there are some uncontroversial reasons and some more controversial reasons. So let's start with the uncontroversial reasons. So the obvious thing is to offer a form of central bank money that is fit for digital payments and markets. So the central bank is offering physical cash now as is a foundation of the whole monetary system, of the financial system. So and remember, inside money is convertible into outside money. Okay, bank deposits are convertible into banknotes, and then if banknotes disappear, nobody uses them. Into what is inside money convertible? It's not clear, no? So it's you can always right now. If you don't, for example, if you mistrust your bank, you can always transform your bank deposit into physical cash, no? Because this is what is convertible into. But if physical banks completely disappear, nobody uses them, and there are some countries in the world where this is close to happening, Sweden is an example, the Nordic countries, for example, then into what is the central bank, is inside money convertible? So the central bank has to offer something that is fit for the digital world. And this includes universal access, safety, and so on. So if you want a safe form of money, if, again, banknotes are not used anymore, then we need to have something that is digital. Probably a second uncontroversial reason is to protect monetary sovereignty. So we discussed this when we consider stablecoins. Remember, stablecoins such as Libra could be in principle denominated in other currency. So in theory, you can have a stable coin, you can have a dollar-denominated stable coin used by, for example, a big tech firm in other jurisdictions. So in the euro area, you may have a situation where you have stable coins denominated in US dollar. So this would mean that the US dollar would become de facto the currency. So pricing would be in US dollar, not in euro. So monetary sovereignty, so the idea that the euro, for example, is the currency used in the euro area, would be at risk, would be jeopardized. So offering a digital form of money that is alternative to these stable coins is a way to protect the monetary sovereignty. So if people use digital euro, for example, and not a dollar-denominated libra, that protects monetary sovereignty. So make sure that the euro is still the currency of the euro area. Is that clear? Okay. So this is a second quite uncontroversial reason. A third uncontroversial reason, which is probably, I mean, to me at least, is the most important, is that, I mean, we have already seen that stable coins or even other forms of digital currencies may be provided by firms in a monopoly position. So there is, we discussed, now is there a national monopoly? There is a tendency towards agglomeration, and this monopoly situation gives rise to distortions. So you can have rents, so high rents, I mean, typical of monopoly situations. You can also have operational risks. Suppose that the payment system is dependent on the operation of a single big tech firm. If then this big tech firm has a problem, would that lead to a collapse of payments, which would be a disaster for the economy as a whole? So there is also this operational risk aspect. So if you have a system without redundancy, without backup, then and is driven by a single or a very few big tech firms, then this would create a big operational risk. So we want to avoid that. Okay. So you can argue, you can argue by shouldn't antitrust. Now we discussed there are antitrust authorities. Shouldn't antitrust authorities deal with that? And the answer in principle would be yes. So this should be in part a job for the antitrust authorities, but we know that it's very hard to run an effective antitrust action in digital markets, partly because these digital markets naturally lead to national monopoly. So there are economies of scale that are very strong in digital markets, and so antitrust has a hard time fighting these economies of scale. So given that we know that antitrust is struggling with digital monopolies, then the idea would be that if the central bank can offer an alternative, create some competition towards these private sector monopolies. Okay, so it's a bit, if you want, at least you have two monopolies competing. There is a public monopoly and the private monopoly. At least they compete with each other in the digital payments place. Okay, so that is probably, at least for me, the most kind of relevant reason for introducing a CBDC. And then perhaps a fourth consideration is data protection. So we know the central bank has no commercial interest in exploiting data. So a big tech firm may have an incentive to steal your data, or steal maybe is a bad word, maybe to use your data for other purposes. So you may be forced to use a form of money that then creates data that is used not necessarily against you, but at least not in your interest. And so at least the central bank has no commercial interest in exploiting data. So you can have a higher confidence, or one can have a higher confidence that there is no misuse of the data, or there is more attention to data and privacy. So any questions on this? You agree with these kind of, to me, uncontroversial reasons? I mean, are you worried about privacy? Is something that worries you? Privacy? No? Why not? I mean, I know of evidence. I mean, people say that they care about privacy, but I know a couple of papers saying that when actually people are asked to pay for privacy, the willingness to pay is low. So for example, if they tell you, okay, there is a Facebook account that is free, but then they will steal your data, or there is a version that is, hypothetically, there is a version that is not cost-free, you have to pay for it, but then your data protected, then people apparently are willing to pay very little to have this protection. So actually, even people say that they care about data privacy, it's not clear that they are willing to pay a price for it. So this is what I read in a couple of papers, but I think everybody has a different. Again, there is a lot of cultural difference. I think in Europe there is a lot of concern. In other parts of the world, I think much less. The US is already much less. But so privacy is potentially a big issue here. Of course, I mean, the privacy issue, I mean, we'll come back to that perhaps in a moment. The privacy issue can also be a problem for CBDC as well, because people can say, yes, I don't want to sell my data to Facebook, but why should I sell my data to the government? No, and so there is also this also. So the central bank will say, I have no interest in exploiting the data, but this may not be trusted by everybody necessarily. So this could also be kind of a downside of a CBDC, because then it's a form of money where in principle data are storable. So the central bank might, I mean, they will probably not do it. They will not do it for commercial reasons, but they want to do it for other reasons, like legal reasons and so on. So that's it's a problematic area, I think. Okay, so if there are questions, then I go to the more controversial rationales, so more controversial reasons. So one discussion that has accompanied this kind of pushed towards introducing a CBDC is that this CBDC can be used as an unconventional monetary policy instrument to overcome the zero lower bound. So ZLB stands for zero lower bound on interest rates. So let me ask you, why are nominal interest rates bound at zero? So why can't we have a negative interest rate? What is the reason? Yeah?
It's create an arbitrage opportunity for commercial banks?
Yes and no. It kind of is close, but it's not the fully correct answer. So at least the average with what? So what would you average with?
In the absence of storage costs, I could borrow as much money as I want and just.
But which form of money?
In this case, reserved or not in cash is yeah, for this commercial method would be reserved.
Well, the issue that you can impose a negative rate on reserves. So in theory, the argument of arbitrary reserves doesn't hold, because the central bank would say, I remunerate reserves by minus 2%. But the problem is that the physical banknotes have a zero interest rate by definition. So the problem is physical cash. Because physical cash, you cannot have a negative interest rate on physical cash. The physical cash always has a zero nominal interest rate. Okay, so there have been ideas also to how to introduce a negative rates also on physical cash, but these are quite outlandish. In general, I mean, by kind of some kind of approximation, you can say physical cash has a zero interest rate, and given that physical cash has zero interest rate, and you can always hold the physical banknote, in principle, interest rates can never go below zero. Yeah. Yeah, so that exactly. So inflation, of course, in real terms is not true. So the interest rates are not bound by zero in real terms. You can have high inflation, you can have a strongly negative real rates, but in nominal terms, the interest rate is bound at zero. So this is what is called the zero lower bound, ZLB. Okay, so it's not exactly true because, as I said, cash has storage costs. Okay, so you cannot pile up a huge amount of cash, which you would need to do if you were doing arbitrage with cash. Okay, so given this cost, actually interest rates can be a little bit negative. So right now, for example, they are negative in Europe. Okay, so they can be a little bit negative, but probably not very negative. Okay, so this arbitrage with physical cash may not happen if the interest rate is, say, minus 25 basis points, minus 50 basis points. But if the interest rate was minus 10%, probably people would start accumulating physical cash, which again has a nominal rate of zero. And so this is what prevents interest rates from falling below zero, strongly below zero. Okay, so this is a constraint for monetary policy. Because then if the interest rates are bound at zero, when you have very low inflation, and you will need to push interest rates even below, you cannot do it. Okay, they are bound at zero. And there is an enormous literature in economics about this zero lower bound problem. Okay, so the interest rates actually have been at zero lower bound for over 10 years now. Okay, so it's not a kind of a quixotic academic question. It's a real life question. So the interest rates have been at the zero lower bound. In Europe they're still below zero right now. So okay, so we have this problem. This problem derives from physical cash. Now with the CBDC, so if physical cash disappeared and CBDC were introduced, this problem would disappear, because you can write a negative interest rate on a CBDC. Okay, so go to the second, perhaps the second bullet point is misplaced. So go to the third bullet point. So the CBDC can carry interest, and the interest can be below zero, can be negative. And as I said, the zero lower bound depends on the existence of physical cash. So if physical cash disappears, then then you don't have a zero lower bound problem. What is the downside of it for some is that now central banks can actually impose negative rates. So some people say so far the existence of physical cash prevents the government or the central bank from imposing negative rates, which is good for savers, for example. People may, in Germany, for example, there is this argument that is not good that interest rates go below zero, because then if you have savers or if you are retirees, etc., so some degree of protection, again, this is what some people are, I don't agree with that, but some people are arguing that way. Some degree of protection from negative rates is good, because otherwise the government or central bank would abuse its ability to manipulate interest rates. Okay, so and this again is given by physical cash, but if physical cash disappears and the CBDC becomes the main form of outside money, replacing physical banknotes, then this limit disappears. Okay, so the central bank can impose even very negative rates. So the interest rate can be -7%, -15%. Okay, it can be very large.
Why would they do that?
Well, because I mean, if you have a recession and very low or negative inflation, the interest rate should be negative. So the interest rate should be adjusted with inflation. So if inflation is high, the interest rate should go high. If the inflation is very low, then also interest rate should go low. But central banks can actually increase interest rates as much as they want, but they cannot lower them, because then there is a zero bound. So if you are in a crisis, you may want to have interest rates at -5%, but you cannot do that. So that's why central banks have done all these QE, these asset purchases. They have done this exactly because there is zero bound.
That's just for our recession case, because if you want your economy to grow, you need savings, right?
Yes, but that's a long discussion. But people say one way to look at it would be to say interest rates have a kind of an equilibrium level, to which basically it's a level which is called the natural level. So it is a level to which they tend to go, over long periods, long-term average. And people say because of demographics and other reasons, this equilibrium level is actually below zero in some countries. So people say from Europe, the equilibrium interest rate is below zero. So the actual interest rates will fluctuate around the level which is negative. So most of the time in Europe, actually the interest rate should be negative, or at least should be around zero. So can often go below zero, because basically there is a lot of demand for savings. I mean, the population is getting older, so the demographics and all, there are several reasons, but demographic is one. So everybody wants to save. This lowers the equilibrium level of the interest rate. So the equilibrium interest rates can also be negative. And there are calculations in Europe saying that, or in Japan, saying that the level is negative. And so the central bank, which moves the interest rate around this kind of equilibrium level, must be able to go above or below the natural level. And if the natural level is minus 3%, then the interest rates might fluctuate between plus 2% and minus 7%. But the minus 7 is impossible now. So that creates an asymmetry. So you can only go up and you cannot go down. Is that clear?
So when there is too much saving, interest rates like should average minus.
Well, exactly. If everybody wants to save,
Yeah.
this means that the interest rate has to go down, no? Because everybody wants to save, and we are now. This is called by some the saving glut. So the saving glut hypothesis is that everybody wants to save, and if everybody wants to save, the equilibrium level of the interest rate can go below zero. I mean, here is more than the real rate, not the nominal, but the real rate. But even the nominal one may often go negative, which is impossible due to the zero lower bound. So this creates all these problems. It is the reason why central banks have done quantitative easing, purchasing government bonds, is always to overcome this problem. So if there was no zero lower bound, they would not have done it. It was just the reason to overcome this problem. Okay, what I want to say here is that in a new world with the CBDC, all these problems could disappear. So the zero lower bound disappears. So central banks don't need to do QE and so on. So you can do monetary policy by just using the short-term interest rate. And then we can move also to the second bullet point. So so radical change could become possible. So the central banks becomes the bank of everybody. So this is what the concept of reserves for all is. They can use CBDC for helicopter money. Helicopter money means that the central bank could make direct transfer to citizens. So say if we are in a recession, inflation is very low, we are in a recession, we need to expand the economy. The central bank can send an amount of CBDC to everybody. You say everybody gets 3,000 euros of CBDC. Okay, this automatically creates a monetary expansion. You can have direct transfers. And all of us would have an account at a central bank, which the central bank can credit to make money transfers, and it can run monetary policy also in this way through us, no? Okay, yeah.
But wouldn't that depend on the actual structure of a CBDC? Because I mean, there are also proposals that include private actors, for example, right?
Yeah.
And there you wouldn't have
Yeah.
change to them for everybody, but just the oversight of the central bank for private actors,
Yeah.
then providing.
Yeah. No, exactly. I will discuss these design issues in a moment, but you are right. So not in all designs, the central bank has a direct relation with citizens. It's unlikely that this will be the case in big economies. It will be intermediated. This is also one limitation of CBDC. But I mean, here I'm making it more like outrageous change statement. So basically saying, I mean, this is inconceivably, in a long-term future, it's conceivable that all of us will have an account at the central bank, and so the central bank becomes a very large monster, which then has a very large, huge balance sheet. Okay, and then you also have to lend to banks as well because of this huge balance sheet. So everything, all the financial intermediation would run through the central bank. Okay, the central bank replaces banks, as a place of financial intermediation. Okay, and another possible use, again, here I'm speaking about the controversial rationales. Okay, so I'm not saying that all these things is coming. I'm saying that people say this could happen with the CBDC. So the CBDC can also be used in fiscal policy. So because the central banks sometimes are fiscal agents, so they make payments for governments, they could use CBDC to basically run fiscal policy. So suppose that, for example, there is a recession, and the government wants people to spend now. Okay, what they can do, a CBDC is flexible enough, in principle, to make very targeted and time-bound transfers. So, for example, the government can say, okay, I transfer you 5,000 euros CBDC, but this CBDC will expire in a year. So you have to spend the CBDC this year. Okay? Or, so this is a time-bound example. Or it could be targeted. It could say, I make a transfer of 5,000 euros, but you have to spend this money in your own country. So you cannot buy imports, you have to buy goods that are produced in your own country, for example, if you want to boost domestic production. So in this, there is an infinite amount of things that can be done with a CBDC, because CBDC is programmable, so it's digital, it's programmable. So you can use it in a very creative way and say yes. I mean, you can, or it can even more extreme cases. You can say, you can even run experiments. You can say, okay, only those whose surname is between the letters A and G can spend the CBDC, and those whose surname is from H to Z cannot spend it. And then you can run, so what happens to the spending of those whose surname is between A and G vis-a-vis those whose surname starts with between H and Z, and all kinds of things. So you can envision all kinds of creative fiscal policies. Okay, so this is another control, but of course not everybody likes this, of course, no? But this is, I'm speaking about more kind of, again, more outrageous uses. Another controversial aspect of CBDCs is to promote international roll currencies. So because digital currencies are more transferable internationally than physical cash, obviously, this means that they can also be used more abroad. Okay, so if somebody in, I don't know, in Poland wants to use a euro banknote, still has to obtain the euro banknote. But if two Polish citizens want to make a transaction using a euro CBDC, it would be very easy, no, for them to use the euro. So this would create, basically, it would need that countries issuing CBDC would make it easier for them to export their currency. Okay, so it could be a way to promote international roll currencies. And next week we discuss more in detail, because next week we discuss the international aspects of these developments. And probably a last point, again controversial, is to protect seigniorage. So do you know what seigniorage is? Yeah.
It's essentially the difference between the face value of the money and the cost of producing the money. So the cost of producing is say €5 bill and €5.
Yeah. You can say that exactly. So the idea is exactly. So I think more precisely is the idea that the central bank can issue a liability that has a zero interest rate without cost. No, so the printing banknotes doesn't cost much money. So as you say, no, so the value of these banknotes is bigger than the cost of production. So for the central bank, this is a source of profits. Okay, because the central bank has a liability with a zero interest rate, and then as an asset side with above zero interest rates. So if I'm a central bank, I can always borrow a zero interest rate, okay, which not everybody is able to do. Okay, so this means that I borrow at low rates and I can lend, so my asset side of my balance sheet is a higher rates. So I make a profit. So this is one key reason why central banks normally make a lot of profits. No? They are a source of profits. What happens with these profits? I mean, a little bit of it is used as operational cost for central banks, but most of these profits are transferred to the treasury. So the seigniorage is a kind of is an easy way for the government to the central bank to gain profits, and then these profits are transferred to the treasury, so they become part of the government balance sheet. Okay, so it's an easy source of financing for the government. Okay, so then a consideration is, if physical banks disappear, this source of income also disappears. Okay, and so this is a problem. It could be a problem because it's nice to have this extra profit for the government and for the central bank as well. So the idea is that if a CBDC is used, the same reasoning applies to a CBDC. So a CBDC would also be issued at low rates or even zero rates, and this would create a seigniorage. It would be it would even be costless, because I mean, printing banknotes cost some money, not as much as they are valued, but they cost some money. A digital currency costs basically zero, at least at the margin. So the senior could even be bigger in that case. So somebody says, yeah, CBDC could be a way to protect seniorage. It's probably not very important, so we are not speaking about very large numbers. So I think the amount is less than 1% of the government budget. I think it's probably even much less than 1%. So we're not speaking about very large amounts, but still could be one consideration. Any other question on these more controversial rationales? Yeah.
Regarding the point of the zero lower bound, so the issue of the zero lower bound would be that if we have negative interest rates, people would withdraw cash from their bank's accounts because they don't want to pay the negative interest rate, right?
Yeah, exactly. So if you have a bank account and the interest rate is minus 10%, then your incentive is to withdraw cash from your bank account and keep the money in cash, because the cash has a zero interest rate. So you would gain that, because then you have an asset which has zero interest rate and your bank account is minus 10. So you don't lose the minus 10.
I would be able to circumvent that with the central bank digital currencies, since they're essentially reserves and therefore not withdrawable.
No, that's not the only reason. The reason is that the CBDC can carry interest, including negative interest. So while the physical cash is zero, because of this design is physical, so it's difficult to impose, a CBDC can have an interest of minus 10. So if you convert a bank deposit into CBDC, also the CBDC also has a minus 10 interest rate. So you don't gain anything. You may still be able in the future, I mean, cash will not completely disappear. So so even in the future, you will still be able to convert your bank deposit into physical cash. But if cash is less than used and loses value, then the argument goes that people will not do that.
So the CBDCs are essentially the new outside money.
Yeah, it's the new outside money, but now with potentially with a negative rate on it. Okay, so you cannot write a negative interest rate on physical cash, but you cannot do it on digital. You can't do it on digital cash. So your digital currency would have also a negative rate. So you don't gain from this arbitrage. Other questions? Okay, here I come back to some of also the questions also that were raised. Key design elements of a CBDC. So one, as other digital currencies, many of the arguments that have been discussed about digital currencies in general, digital assets in general, apply to a CBDC. So one distinction is token versus account based. So should it be like a token that is just independent of who you are, you can use it, or should it be account based? So my name as an individual institution, like a bank account. No, this discussion of token versus account based and all the discussion that we had in previous lectures applies to a CBDC as well. So it's exactly the same as other digital currencies. One key design element of CBDC is whether it could be used in an offline way. Again, one reason why physical cash is used is that not everybody has access to the internet. I know it may sound strange to you, but there are many people actually don't use the internet. I'm also surprised that even now there are people, also areas where internet doesn't arrive. So I have a countryside house in Italy, and in that area there is no internet. So there is no phone signal, which my kids hate, but it's like this. So if I want to make a payment and buy some cheese there, I wouldn't be able to use internet. So I could only use an offline system. So possibility offline is also relevant. There are many questions of distribution, of which I have made a separate slide. There is a question of design. A key one is what kind of monetary transactions we want. No? So should the central bank be able to see the transactions? And here there is a fundamental trade-off. On the one hand, you want to avoid illegal transactions, Okay. On the other hand, I mean, you don't want the CBDC to be used to buy, for example, cocaine or drugs. Drugs in a sense of not drugs in a sense of medicine. Drugs in a sense of cocaine or heroin or things like that, or prostitution and so on. I also imagine the reputational damage. If a CBDC is used to pay for I don't know, child prostitution or stuff like that. No, so you want to avoid that also for reputational reasons. But on the other hand, you want to ensure privacy as well. Cash, physical cash has a high degree of privacy. So this kind of an optimal level of monitoring is tough to decide. No, so, to what where to put the line. One key element is. These last two are probably the most important. So whether one wants to put limits to holdings. So should there be a cap to how much amount of CBDC you want to have, and this may include domestic residents, also foreign residents. So the different limits may be applied to domestic or foreign residents. I mean, for example, in China there is this discussion and. I will come to that, but the Chinese CBDC may be used by foreign residents, but only when they are tourists. Okay, only in a tourist setting. But I cannot use the Chinese CBDC to make a transaction here, for example. So there are different limits. But of course, one must be able to locate the user. Okay, so there are ways. There is a geolocation and so on. But it's not obvious that. The system cannot be hacked, and maybe I will be able to use a CBDC if I'm good enough on as a hacker, without. So this domestic versus foreign in the digital world is always a bit unclear. No? But the idea here is that many central banks, I mean, including actually in Europe, see the CBDC as basically as a means of payment, not as an investment asset. And so the amount, the maximum amount should be small. So I should not be able to hold €1 million in CBDC. It should be a few thousand euros. It should be something that I use in a wallet, in a payments wallet, to make payments. But it's not something on which I should invest big amounts of money. Okay. So the question, of course, is how to enforce them. So there are many technical problems in enforcing these limits. There are, you can think of creative ways to evade these limits. I mean, suppose that I create a new identity. Again, digitally, many things can be done. So you can say I create a copy of myself online and so on. So, in the digital world, the issue of who I am is, becomes a bit blurred, of course. But in principle, there may be limits to holdings. And then a key question is really the remuneration. So in normal and also in crisis times. So in remuneration in normal times means that if there is no banking crisis, how do I remunerate the CBDC? So what is the interest paid on CBDC? Should be the same as cash, namely zero, or it should be non-zero. Because you can argue if this is an electronic form of cash, it should have the same interest as cash. So it should be zero. Okay. But other people say no, it cannot be different from zero. It can be negative, it can be positive. So how is this decided? No, this is one key question: zero, non-zero, and then there is this question: normal or crisis time. So one thing is to say, okay, what is the remuneration in a period when there is no banking crisis? So let's call it a normal times. But then the question is, if there is a banking crisis. So what kind of remuneration do I give to CBDC in a banking crisis? So if people rush to convert bank deposits into CBDC, should we prevent that? One way to prevent that would be to limit the holdings. So I can only convert up to a certain amount of bank deposits into CBDC. But I can also say, in a banking crisis, the remuneration CBDC goes very negative. Okay, so if it goes very negative, this reduces incentives to have a bank run, okay, and so it would be easier to stop the bank run. While if the bank run is towards physical cash, you cannot do much because physical cash has a zero interest rate always, no. So At least you don't lose money by, no, in nominal terms, by holding a banknote, but basically people can be made lose money if they want to hold the CBDC by basically imposing a strongly negative remuneration, strongly negative interest rate on a CBDC. Is it clear? Okay, so if this is clear, we can come to the distribution question. Okay, so there is basically, and the essential question is whether it should be a one-tier or two-tier scheme. So essentially is whether the CBDC should be on the central bank balance sheet, and so you interact directly with the central bank as a consumer, as a citizen, or it is a two-tier system where financial intermediaries distribute the digital currency, and the central bank only interacts with intermediaries, doesn't interact directly with citizens. Okay, this is the design question. And so in a delegated scheme, which is a two-tier system, they may be custodians and intermediaries. So custodians is those who actually hold the digital assets. So there is somebody who says there is a CBDC held by person X at time T. Okay, they keep track of that. That's what a custodian does, keeps track of what. I mean, you know that there are custodians, for example, for financial assets. So when you buy a bond, the bond is physically with a custodian. So there is a custodian saying that bond XYZ belongs to person X at time T. Okay, so this is what a custodian does. In a two-tier system, the custodians would continue to exist also on the CBDC. In a one-tier system, the central bank is the custodian, of course. But in a two-tier system, there may be custodians. And then there could also be intermediaries. So these could be banks. There could be somebody who actually distributes the CBDC. So moves around CBDC and so on. So I think in many countries, my expectation would be that the banks will be the intermediaries and perhaps also the custodians. So we'll have this two-tier system where banks or regulated entities will be distributing the CBDC. So my expectation would be that in this case, a CBDC may feel to consumer like a bank deposit. So it will something to which you will have access through your bank account. Okay. The difference is that this will be completely safe. It is ring-fenced for you. So if the bank goes bankrupt, the CBDC is protected for you. It's yours, no? So it doesn't belong to the banks, it belongs to you. That's a key difference with the bank deposits. The bank deposit is at risk if the bank goes bankrupt. A CBDC, not. But apart from this difference, it's possible that basically it will feel to you a little bit like the bank deposit. Of course, what is the downside of this system is that then in this way you don't reach people without a bank account. So you forget about the unbanked people. Okay, so the big downside is that of this scheme is that what about the unbanked? What about the people who don't have a bank deposit? Okay, but of course, in practical terms, because banks have millions of customers and so on, and they reach almost, not everybody, but almost everybody. I think it's a natural. If the central bank doesn't have the resources to interact with millions of people, that would probably be the most natural choice at the beginning, at least. So what happens in practice is, if we have a delegated scheme through banks, so what happens is that the banks, again, they do the same as for physical banknotes. So for physical banknotes, what happens is that the banks borrow the banknotes from the central bank, okay, and then they have a corresponding amount of reserves. But so when the bank gives you a banknote, you go to cash dispenser, gives a banknote, the bank is actually borrowing from the central bank to get that banknote. So the more banknotes, the more borrowing by commercial banks from the central bank. Okay, is the way it works. Is the way it works in most countries. Okay, so banks, it doesn't necessarily have to be like that, but it's the way it works in most countries. Is that the banks borrow from the central bank to get physical banknotes, and the same would happen with the CBDC. Okay, so the banks would borrow from the central bank and obtain the CBDC, and then they would distribute the CBDC to citizens. Okay, so the banks would be basically intermediaries. So this will, of course, expand the central bank balance sheet, unless a CBDC just replaces banknotes. So if the CBDC is just used to replace banknotes, then the effect will be small, because basically one part of the central bank balance sheet would go down, so banknotes would shrink, and CBDC would expand. So the effect on the size of the central bank balance sheet would be the same. So the effect will be zero. So the central bank balance sheet will be the same if one is substituted against the other. Otherwise, if CBDC leads to additional demand, so basically it does not only substitute banknotes, then it's possible the central bank balance sheet will expand. So this means that the banks will have to borrow more from the central bank. Okay, so you can argue that if that is the case, so the central bank balance sheet expands, and the banks have to borrow more from the central bank. This might be operationally problematic in some cases. Why? Because when the commercial banks borrow from the central bank, they need to have collateral. So central banks lend to banks only against collateral. Okay. So I'm a central bank. I lend something to a commercial bank. I need collateral in return. So I need the bank to have collateral, to have bonds, to have some kind of assets can be used as collateral. And so if the creation of a CBDC expands the balance sheet of central banks a lot, this means that the banks have to borrow more from the central bank, which means that the banks will have to have more collateral. They may or they may not have enough collateral. So collateral is a bit of a question. But in principle, this is doable. So in principle, apart from deciding also what collateral and if there is enough collateral, but in principle, it's doable. That basically there is more borrowing from the central bank, and the banks then, like they do for physical banknotes, they distribute the CBDC to citizens. Okay, but keep in mind, however, that a CBDC can be distributed in different ways. It's a digital asset, like Bitcoin in a sense, so can be distributed on blockchains, can be distributed in distributed ledger technology or any other way. So it's very flexible, so can be used in different ways. So distributed to the banks is one way. Again, my expectation would be that in many countries it will be the beginning, just because banks reach most people. But I would not exclude that there will be other ways of distribution, including blockchains, etc. So in that sense, being a digital asset is flexible, so it can be distributed in different ways. Any question on that? Okay, so criticism of CBDC. So not everybody is happy about the CBDC. So let me outline a few criticisms. I will come back a bit to this question, however, in the last lecture as well, when we discuss the future of money. But let's discuss a few now. So some people say, okay, why then we need a CBDC? Is a solution in search of a problem? So why exactly do we need it? So for more kind of arguments on that kind of point, so these people say, okay, maybe the downsides are not big, but what are the upsides? So there are not enough upsides. I think probably the best source for that view is a speech by Quarles, which is very much on that line. And this is also what some policymakers, in particular in the US, have argued. So what is a compelling reason to have a CBDC? And the paper by Schilling, Fernandez, Villaverde, and Uhlig argues that so why do we want to have something that may put financial stability at risk? Which I think I have a slide after this one. So why do we want to pay this price to have something that has a minor impact on monetary policy? So why do we want to pay this price? So what is the problem that this CBDC solves? No, I mean, to me, I mean, the answer to that question is really in here, no? So if you ask me, okay, what problem is trying to solve, then this one, I would offer this one. So I would say the problem is trying to solve is to say, how do we protect monetary sovereignty, monopoly distortions, data protection. These are what I would argue are the reasons, but then it's a question of judgment, whether these reasons are important enough to justify the introduction of CBDC. But just keep in mind that there are many observers who believe that that this is that it's not clear what problem it is trying to solve. There was also a report, I show you, there was a report, so the UK House of Lords also has a very critical report on central bank digital currency, and it argues it's a solution in search of a problem. So why do we do that? And also this paper is a bit also in that direction. So basically they argue, so price and bank stability collide means that we have something that as a marginal impact on central bank's ability to achieve price stability, but there's a big cost in terms of bank stability. So because CBDC can jeopardize the stability of banks or undermine banks, then the trade-off is not favorable enough. The second argument is a bit the kind of the opposite of what we said before. So remember, before we said, okay, commercial banks are better than big tech in protecting your data, but people say, okay, but do we really want to give data on our transaction to a central bank or to the government? For example, think of it in China. Should the PBOC be able to track all payments? Is it of course, I mean, so what is done in China, of course, would not apply in Europe or in the US, but still there is a lot of resistance to the idea that payments would be trackable for the government. So I think especially people are more libertarian. They fear that the government would be, watch your payments. And so they argue, physical cash is better for that. So the physical cash is anonymous. So in terms of protecting yourself against the government, cash is better. Okay, so here entirely depends on whether your view of the government is positive or negative. Of course, if you have an oppressive government, it's not a good idea to have a CBDC. But if you believe that your government is essentially trustworthy, or I don't know, so then why not have a CBDC? So it really depends on your view of the government. But some people say, okay, this may lead to a Sovietization of the economy. So the government being able to track what is happening is a way for, opens the door for central planning. Okay, so the government, in principle, the government could use CBDC to ban certain activities, or to say, okay, this cannot be done or this can be done. Okay, so it would be like the Soviet Union. So what is the response to that? So can you provide me a couple of counter arguments to that? What would you say if you were asking? Okay, provide counter arguments to that criticism. What could it be?
But cash is not anonymous.
Why not?
The argument that cash is not anonymous.
But cash is anonymous.
Yes.
Yeah. No. The argument that basically that is basically bad for privacy. That introducing CBDC is bad because the government can track your payments. Can you think of a couple of counter arguments to the criticism? If you were charged with introducing a CBDC, well, how would you counteract that? I mean, will cash disappear? No. So one way to answer that would be to say, okay, cash will continue to exist. So if people really want to use cash, they can continue to use cash. So cash will not be banned. So, but it's just that people will not. So it will be private competition between cash and CBDC. So if people will want to continue using cash, then this will be possible. Yeah.
tools that the CBDC creates, then they won't exist, right?
Exactly. So if people continue to use cash, then CBDC is not relevant, and it will have no benefits and no costs. So if people don't like a CBDC, then they will not use it, and CBDC will not. And this, by the way, is an important point also, that you can have you can have both scenarios. So you can have a scenario where it's very successful, and then all these problems come, including like undermine the banks, on which I have a next slide. But you can also have a situation where nobody wants to use it. Nobody wants to use the CBDC. People prefer stable coins, Bitcoin, or even bank deposits. So eventually the CBDC can be a flop. But in that case, it will not create. There will be no cost, no benefits.
But there's also the case where you can use cash and CBDC, right? Like
Yeah, exactly.
For example.
Exactly.
The problems from the CBDC will be there, or not so much, or.
Well, I would say that probably the less CBDC is used, the less problems it would create. Of course, you can always have problems at the margin, so you can have little use, but then in a bank crisis, you can have digital runs, of which I will discuss in a moment. And so this also will, could create problems at the margin, not only in a steady state, but in principle, yeah, less use means also less problems, of course. Okay, so then we have the problem of bank disintermediation, both in normal and crisis times. Again, next slide. Another problem that people mention is called strategic autonomy. So this is becoming more and more popular now. So the idea is that you should not depend on foreign firms on your critical infrastructure. So it's a bit of a more geopolitical concern, also in times of sanctions and so on. So some people fear that if a CBDC is based on foreign technology, this leaves the door open for foreign governments to intrude in your, for example, payment system. So, for example, if a CBDC is used or is introducing with a cloud services, and if cloud services are provided by, US companies, then your CBDC is, unlike physical cash, of course, the CBDC is dependent on actions by the US government. So the US government can say, I impose on all US firms an obligation not to have, not to use the cloud for citizens of that country. This could block the use of CBDC in that country. Okay, because you are using foreign technology or technology provided by foreign firms for that purpose. Okay, again, it's something that you don't have for physical cash. So you may be dependent on foreign technology because, most of this being digital and the digital based on technology, it may well be the case that big techs and foreign firms are in a dominant position. You are dependent on actions by. So this is becoming more and more a concern with these tensions. First the tensions between China and the U.S., then the war in Ukraine, the sanctions. All the discussion has become more and more important in many domains, including the domains of digital assets. So you say that there is a digital euro. You don't want the digital euro to be hostage to what the U.S. government or the Chinese government do. And the final point, obviously, is cyber risk. Of course, if cyber risk is important, obviously CBDC being a digital asset is more important. So a physical banknote is impervious to cyber risk, but of course CBDC in principle is affected by cyber risk. So if there is a cyber attack or a hacker attack, this in principle can also affect. But this applies really to all digital payments, not only to the CBDC. Okay. So let's discuss about bank disintermediation, unless there are questions, and then we can conclude more or less. Okay, so CBDC and bank intermediation, disintermediation. So here the idea is that so would people use a CBDC and substitute away bank deposits? And here the considerations are not very different from stable coins. So remember we had the discussion when we discussed stable coins. We said, okay, it's possible that stable coins will replace bank deposits in part. Will it be good or bad? And we said it depends. You know, it depends whether this will. So it would be good if this removes monopoly rents in the banking sector. Okay, makes the banking sector more competitive. But it could be bad if banks lose net worth. So makes banks less rich, if you want, or with less net worth, and they will be less able to operate. You know, less able to. So this is. I would say the same considerations in principle apply for CBDC. So if CBDC is a competition for bank deposits, same transmission channels, again, can be good or bad, happen with CBDC. So, yeah.
But if we have a system where the digital currency or the central bank digital currency is located within the commercial banks, then we would have the competition for bank deposits not with an outside player, but with just a different form within the same company, right? And then, so at least when I think about it, if I have the option between a bank deposit and a deposit of some kind of CBDC, and one is fully guaranteed by the central bank and the other isn't, and it's the same actor providing both services, then at least for me there's no need for a bank deposit. Because I keep my account at the same bank, but now it is fully guaranteed.
Yeah. No, you are right. So of course, so if the two are exactly the same and the CBDC is just safer, then why holding a bank account at all? So that would be the horror scenario, in which bank deposits disappear and the banks become completely disintermediated. So they lose all the liability side, and therefore they cannot lend on the asset side. So the bank's balance sheet will shrink, because the CBDC is a liability of the central bank, not the liability of the bank. So basically there will only be borrowing and lending between the central bank and the commercial banks, but the commercial banks will not lend to firms or to the real economy. That is actually the horror scenario, which must be avoided. Yeah. You have the question?
Yeah, it was exactly my question, how then financial intermediation would work. Then, because in this case, the commercial bank would essentially, as you mentioned before, act as a custodian and not
Yeah.
in a sense.
Exactly.
So the central bank in this case would make all the lending decisions. The commercial bank.
Well, the central bank probably would lend. That is what financial system we have. I mean, one could consider a case. Okay, so let's consider this horror scenario. So what would be happen in the horror scenario is that all bank deposits are replaced with a CBDC. So basically, the balance sheet of central banks becomes enormous, and probably the central bank would have to lend to banks. So probably there would be actually the banks would lose the deposits with citizens, but they would have a huge amount of deposit with the central bank, and then they would lend. But this is a system which is entirely based on the central bank. So of course the actual lending will be done by commercial banks, because the central bank does not have the ability to lend to business, to firms and so on. Only the banks do, no? But everything would go to the central bank balance sheet. So in a sense, you could argue that there will be a new system all based on the central bank, but that would be a bit of a monster, no? The central bank would be a monster. Yeah.
You were saying that they were considering to make a cap for the CBDC. That a person could just hold like 10K in his wallet. Then
Yeah.
you will need actually a bank account or deposit to have your savings, like
No, exactly. So this is exactly what the sub bullet point says. So basically, this risk is so this horror scenario, this extreme scenario, is less likely if the CBDC is used for payments and not as an investment asset. So if there are caps or things like that, then is much less likely that you would use that it would completely replace bank deposits. So in that sense, So in other words, I mean, to prevent this kind of extreme scenario, one has to make the CBDC a bit less desirable than deposits, or at least not as desirable as deposits, because then indeed the risk of complete substitution is there. So you need to differentiate a bit. That's why also a CBDC needs to hit the sweet spot a bit. No? It needs to be in demand, but not too much in demand. So hitting this sweet spot will be one of the most difficult things for central banks to do, because you want people to hold some CBDC, otherwise it will be a complete flop, but you don't want them to only have CBDC, also. So we have to hit this intermediate K, which is not easy, yeah. Okay, other questions on this? Yeah. Also, I mean, bank deposits in theory are also, mainly a payment. So you should not actually hold your savings in a bank deposit. It's not a good investment always, no. But of course, many people do hold bank deposits as investment, especially the less sophisticated, those who don't invest in equities and so on. So de facto is used as an investment means. Okay, but again, all these considerations are actually similar to what we had on stable coins. What is specific to CBDC here? What is different from stable coins is specific to CBDC is more in the sense of a crisis. So because the CBDC is safe, as is perceived to be safe, is more likely than stable coins and other digital assets, more likely to be used for runs. So if you have doubts about your bank, okay, and you want to withdraw your money from the bank, I would say it's much more likely you do use a CBDC than another digital asset, okay, because it's safe, So are you familiar with bank runs a la Diamond Dybvig? Have you studied this? The Diamond Dybvig bank runs? No? Really? Okay. Okay, I would say let's do this last, and I will start next week. I will do the rest of the lecture because we are already close to 10. So let's do the runs, and we stop here today. So a bank run is, I think we discussed this already actually. A bank has deposits on the liability side and lending, some form of lending on the asset side. The liability side is liquid, the asset side is illiquid. Okay, the liquidity transformation of the banks. Remember that the banks do liquidity transformation. You remember the fractional banks and so on. All the discussion on narrow versus fractional banking. So in a fractional banking system, banks have this liquidity mismatch. So liquid liabilities, illiquid assets. If there is a bank run, suppose that people develop a belief, which can be even without reason. So there is a belief that the bank is going to fail. So you want to rush to withdraw your bank deposits. You can do it because it's liquid. So you can rush and withdraw your bank deposits. This will create a big problem to the bank. Why? Because the bank will have to sell its assets, so its lending. So you have to liquidate its lending because its liability side is shrinking. And this is hard to do in the short term. Why? Because the asset side is illiquid by definition. So this is why banks are fragile. Okay, so the model, the economic model describing this was introduced by Diamond and Dybvig in 1983. So there is this famous paper, Diamond Dybvig in 1983, where they discuss how this bank run works. So it's a mathematical model of a bank run, but basically says, okay, so think of it like this: that suppose that you are a bank and you are financing the construction of a skyscraper. Okay, so your asset side is lending to a developer of a skyscraper, and then suppose that it takes 2 periods. So in the first period you build a skyscraper, and in the second period you finish the skyscraper, you sell it. If in time 1 your bank depositor say, I don't trust this bank, I want to withdraw my money, what the bank is forced to do is to withdraw the lending to the developer, which means that the skyscraper remains half built. Okay, and the value of a half built skyscraper is less than half of the value of the skyscraper when it's finished. Okay, nobody wants a half-built skyscraper, basically, no? So the bank will have to liquidate this illiquid asset. Think of a skyscraper in the short term, in the short period, and basically the idea is that it will lose value. It will lose value by liquidating this illiquid asset. So selling what is a half-built skyscraper. Okay, and so because the bank has this loss, the bank will eventually fail. So the bank will go bankrupt just because of the bank run. Okay, so shrinking the balance sheet very quickly will lead to a loss because the asset side is illiquid, and this loss will lead the banks to fail. Okay, so this is why bank runs, especially economy-wide bank runs, are very destructive. We have seen this in the Great Depression, we have seen this in the global financial crisis, in many other banking crises. So there is these runs are very destructive because then the banks had to shrink the balance sheet, shrink the lending, and this leads to real losses because many projects cannot be finished and so on. So the real economy cannot get financing. So many projects cannot be finished, etc. Okay. So this is a Diamond DB bank run. So now CBDC. So what CBDC does is the possibility of having digital runs. So rather than people going to the bank in person and convert the bank deposits into a banknote, which at least takes some time on some effort, now they can do this on a mobile phone. So they can basically sell the bank deposit and buy CBDC. CBDC is perceived to be safe, so very easy to have a bank run. So this is one of the main worries in introducing a CBDC. So the possibility of digital runs. Okay, CBDC has no storage cost. So at least if you convert it into a banknote, you have a storage cost. But CBDC has no storage cost. It's very easy to. So imagine, for example, Greece 2015. So there was a banking crisis in Greece, and Greece had to impose a limit to the conversion of deposits into euro cash. So you can only withdraw euro cash up to a certain amount. Okay, so but suppose that this could be done using mobile phones and so on, there could be a huge outflow of deposits. So there could have been a huge, a much bigger crisis, etc. So this is the digital run. Okay, I would say we stop here today, and so we start from this bullet point next week, and we go through the rest of the lecture. And then so that will take probably like 15-20 minutes, and then the rest we'll discuss international aspects, which is also interesting. Okay, so thank you.